Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Typically joining me today would be Michael Becker, but again, doing another due diligence exercise. That guy is busier than heck. So in the podcast today, we have James Eng, also with Old Capital. Thanks for hanging out with us, James.
Hey, Paul.
We appreciate that. So in the podcast, we have some friends of ours, and we have financed a few apartment properties for them, and I wanted to share two recent stories or experiences that they just had. One was on a property that they just sold, and one was on a property that they just bought. So I wanted to understand a little bit more about both, so let's jump into the conversation. So Sven and Rebecca, thanks for being on the podcast, and we appreciate that.
Thanks for having us, Paul.
Thank you, Paul.
No problem.
Thanks, James.
So let's get to know you guys a little bit better. We had you on a past podcast maybe about 2 years ago or so. So it's been a period of time. So let's talk a little bit about your background and what you do and where you're from.
Well, we're in the Dallas area for the last over 20 years. We've ran our old business for over 20 years. In about 2013, we decided our business wasn't heading where we wanted it to head, and we needed to take a change in life. And so we knew we liked real estate. We had bought some single-family rentals, and we decided that they weren't happening quick enough for us to supplement the income from our other business. So we did some research, and we discovered multifamily and investing in multifamily, and we had attended a seminar of Brad's in June of 2013. And we knew that by noon on the first day of his seminar that we needed him on our team if we were going to get where we wanted to get. It was exactly what we needed to supplement our income, and that just started us on the road to multifamily investing.
What did you see in apartments that was different than single family that you liked?
It was the economies of scale. It was the ability that you're actually purchasing a business and you would be running a business versus being self-employed, which we had been self-employed, and we were looking to get out of the self-employed area.
Okay.
And it was as well as the support that you would have. You would have mentorship that would teach you how to do what you needed to do and would provide you with the context, such as Paul and yourself, James, for the financing, for the mortgage, meeting realtors so that you can find the properties that you want, due diligence, how to evaluate the properties, property management companies, everything was provided through it.
Sven, how important is specific multifamily education?
I think it's tremendously important. We know how to run a business. We did that successfully for 20 years, but we didn't know anything about multifamily. And so for us, in order for us to invest our money in it, we wanted to make sure we have a mentor who has done that, has proven himself, and can teach us on how to do this successfully so we don't risk our money we have earned in the past 25 years. So it was tremendously important for us.
Mm-hmm.
Maybe you can give us an example of in one of the three transactions that you guys have purchased where either having a mentor or team members really benefited you significantly. Do you have maybe one example to share?
Well, right off the bat, the initial acquisition of our small 41-unit property in Dallas, Shelby 2707 Apartments, it was an off-market deal that was brought to us through our mentor, Brad Sumrock, and it provided us with an opportunity that we maybe wouldn't have gotten otherwise.
Okay, so let's jump into that deal really quickly. When did you guys buy that deal? How many investors did you have in that deal? And just sort of tell us the story on that one, and we can talk a little bit about the disposition as well.
So we bought Shelby in 2014, June 26th of 2014. It's a 41-unit complex and located in the Oak Lawn area, close to Uptown in Dallas, a really nice area. The interesting part of that our goal when we started in multifamily, we wanted to buy a pitched roof, individual AC unit, and slab foundation. And that property was actually a flat roof, chiller system and pier beams. Okay, and
The trifecta.
So our mentor always said to us, I said, does that mean you failed? And absolutely not. It was a very, very great property, a great location. And with our mentorship and the team we put together through our mentorship, ensure that it was a very successful property, a very successful acquisition. And the lending side of it was so interesting because we actually were achieving what we call the non-recourse loan in our first acquisition. Through Paul, he helped us with that. And in order to get a Fannie Mae non-recourse loan, made that deal even more interesting to us. Yeah. So anyway, we purchased it in June 26 for $2.4 million, 41 unit, which was at that time
a significant
price per door, which was about $60,000 per door.
Yeah.
But we had a vision to reposition that property. It was actually called differently, so we rebranded it. And the way the Oak Lawn Uptown area was changing, we wanted to have actually changing it from C-class resident to a B plus type young professional resident, and increase rents and make this property completely different than it was before.
So the rents at acquisition were approximately what, and what did you have them at when you sold? Do you remember?
They were about $740, but they were giving them a move-in special to have them move in, so it was about $720 per month on the one bedrooms, which was majority was one bedrooms. There were only 4 2-bedrooms, and when we left, the last lease we signed was $950.
Okay. So $230 rental increase per unit, which is pretty sizable. But how much rehab did you guys invest in that property?
$100,000 we had budgeted.
Okay,
we
so you did 100 in rehab. Yeah. Okay, all right. And where was that money spent on that property?
We put about 50% on the exterior, and maybe 60% of the exterior and 40% on the interiors. So the exterior consisted of a new roof, TPO flat roof, basically some landscaping, cleaned the property up, did the exterior painting, completely new rebranding, and there was put new water heaters in, and then the interiors really continued the process. Already had some nice flooring in it, but we did a new paint scheme, nice modern two-tone paint scheme, modern lighting, just cleaned it up and upgraded the units just a little bit. And that really all we needed to do in order to bring that property to where it was when we sold it.
And how did you guys manage that property?
Well, we self-managed it.
Okay.
We were the property managers, but we did hire a staff. We had an office manager. We had a maintenance guy. And then eventually we added our own in-house housekeeping person that also did the yard care on site. And then the following year we purchased another small property. So in order to make it affordable, we split their time between the 2 properties. They worked 3 days at each property.
So how much time did that take? Because a lot of people are, I think, scared of self-managing, especially they're used to maybe doing single family, but then moving into a 41 unit and self-managing. How much time did that take, and what was the majority of your responsibilities?
So let me say like this, our mentor, what he really teaches is to have third-party managing. And that's really what our goal was as well. But like the pitched roof and the flat roof, that didn't work here either and applied because it was only 41 units, which it didn't make sense to have a third-party management in place. The previous owner did have that. And when we were looking at the numbers, we thought, we can do better self-managing, get more out of the property, keeping our own eye on it, managing it ourselves. And that's what we decided in doing. And so I think the first 6 months, you're probably going to spend quite a bit time at the property until we had the staff we wanted. Yeah. We probably spent 40 hours a week there in order to get the right staff and get the right people and get things started the direction we wanted to. Once that was in place,
we could easily take off a week or 2 if we needed to because we had the right staff in place. But like you said in the beginning, it was full time there all the time, keeping an eye on it till we build it up. And what we found too is on the small properties, the residents like that small community feeling. So they like knowing it's mom and pop there. They like knowing the owners, and they like seeing us. They like at least seeing us show up once a week.
Okay.
So then they feel like we care about the property. They know it's taken care of, and then that just adds to it. It's almost like an amenity to them.
No, we met with some property management companies while we were owning it and discussing actually the option, because they were managing other properties in the neighborhood, and them actually maybe taking it over and doing it for us, and we would then be removed completely. But we decided not to do it just because we liked what we were doing. But I think it would be a valuable option to do that for somebody, get a local management company in that neighborhood and then have them basically manage it with the other ones. It could be done, I think.
At 41 units, what kind of a percentage would a property management company charge you on that? Do you remember?
Probably 4.5%.
Oh, I would say 6 to 7.
Think so?
I would say 6 to 7, yeah.
Just depending on how many properties they have in the area, probably,
Yeah.
and
Right.
how many days they need at your property, right?
Yeah.
So,
Yeah.
okay. And then, so after about 3 years of ownership, you guys decided to sell the asset.
Well,
And how did you make that decision?
Well, we held an investor meeting and went to the investors. And actually, originally, we'd looked at doing a supplemental loan to take our equity out of it because the type of loan that we had on it, it was a Fannie Mae loan. So it would have meant that to sell it, the new owner would have to assume that loan. They couldn't go out and get a fresh loan. And if we sold it without them assuming it, there was such a prepayment penalty that our return for our investors was greater for us to do a supplemental loan and keep the property than it was for us to sell the property. But once we were able to find an investor that wanted to purchase it and assume the loan, it then became more advantageous for our investors, for all of us to sell the property and get out of it because we had a greater return then.
Okay, so you sort of looked at it both ways and said,
yeah.
if we do a supplemental, keep the property, it's up and running now, but if we sell it, we could get all the equity out.
At the time that we did the deal, we had projected in year 3 from 10 or 12% return to our investors. But from year 2, we were returning 15% a year for our investors. So they weren't in a hurry for us to sell it because they enjoyed getting that check every quarter. So, yeah.
Okay. All right. So once you found a buyer that could assume the loan, you guys got it under contract. And then once it was under contract to close, anything that came up from the buyer side that...
Well, what was interesting was when we were going into the contract, going through the contract process, our buyer actually didn't use a true multifamily broker. He used a residential type broker that did high-end properties, and he used a lawyer that wasn't familiar with doing the contract for a multifamily type deal, and it was a really long, drawn-out process. And Sven and I said over and over again, you could just see the asset that we had from joining an organization and getting the education that we did and having the contacts that we had. It makes such a difference in the deal. We did not experience that in the buying side of it when we went in, but we were experiencing this on the other. It just really drug out getting the right contract down. The lawyer...
So we actually, it was actually a California buyer. We actually introduced him to Paul, and because we wanted to make sure he was a viable buyer, and we want to make sure we succeed in closing this deal for both sides, of course. So it was important for us. We had the feeling that he did not have the exposure to the professionalism and professional people we were dealing with. So we introduced him to Paul and to Brad's group, and when we make sure he got exposed to that. And so I think Paul then talked to him and he understood what, I think Paul checked him out a little bit for us, and he was a great person. I still have contact with him. So everything went very smooth after that because we felt like if he is exposed to those people, they can help him to succeed as well. So we both succeeded.
Yeah, he was a good borrower.
Yes.
And he assumed the first lien on the property, and then he applied for a second lien, a supplemental. And between those two together, his loan to value was between 74 to 75%, somewhere in there. So he had to put significant money into the deal, 25%, but he had it. So he had enough money to put down 25 or even 30% in the deal. But I think Rebecca brings up an interesting point, though, that is if you don't have a mentorship that stands behind you and you are, I would say, saddled with the single-family realtor, it's going to be difficult. And the single-family realtor knew this attorney, and the attorney put together his own contract, not a promulgated Texas form, but his own contract from his firm, which was, I think, 60 pages.
Yeah.
And it was going to cost him, a lot of these contracts for the state of Texas, the promulgated forms are for free. And that all the things have been done and all tweaked out. And if you want to make some adjustments, you can. But a contract that's built by an attorney firm may cost him $12,000, $15,000 of cutting and pasting contracts. And the only thing that does is that really it pisses off the seller. Because the seller was like, I'm not signing that. I'm not signing that. I'm not going to sign that part of the deal. And it didn't bring a high level of confidence with the buyer that this deal was going to get done. And of course, the seller was like, this is ridiculous. I mean, just give us the promulgated form, whatever state you're in, usually is already a pre-made form. Try to use that and see if that works first.
Right. And then so we got through the loan assumption and supplemental, got that deal closed. And then I guess at the same time, you had been looking at larger properties. And so you were able to take some of the equity from Shelby and move it into a new deal. So 140 unit deal. Let's talk about that deal and how you found that deal.
Well, we knew that once we were under contract, we had approached our investors, and we knew that the majority of them were wanting to stay in the next deal. And so we were looking at doing a 1031. So we were under the gun to find the next property. So that's why I was on site more then, and Sven was busy then looking for the property. And
Yeah, I've been looking for months before we even got Shelby under contract. So we didn't want to make that as a must that we do a 1031. If it would work out, it would work out. So we would not purchase a property just because we want to do a 1031. So we were looking for a while because we wanted to move up anyway to a larger property, third-party management. And I made quite a few offers to other properties. And then we found that 140-unit property.
How many offers did you make?
We probably made 5 or 6 really serious offers.
Yeah.
And
And you kicked the tires on how many properties?
20, 30 properties at least.
Yeah.
You know? So, I mean, just looking at them all the time. And but the past 3 offers were really serious. We got really close. So it was just for me a matter of time, I think, before we would be able to succeed in securing one. Okay. Again, working together with the team made a big difference, you know. So once we secured the 140-unit property, actually, then it fell within that window to be able to do the 1031. And then, of course, again, we used somebody, a company who was very experienced with that because we are not. So we need to leverage of somebody who has that experience. And so with Madison Exchange, Madison Title, they helped us tremendously in succeeding in doing the 1031 very successfully. So another player and part of our team, you know, who made this all happen for us. We couldn't do that all by ourselves.
Okay, so tell me a little bit about this property. It's over in Arlington, Texas. Mm-hmm. Not too terribly far from Texas Stadium where the Dallas Cowboys play, kind of in between that and downtown Fort Worth, right in front of a I-30, which probably has 1 million cars that go by a week or so. I mean, it is a very busy multi-lane highway. So you're on the front, and people that off the highway can see your building fairly well.
Yes, it's a very, very good location. It's just east of Fort Worth, just west of Arlington, right by I-30. You see the property actually driving on I-30, and it has a red tile roof, has like a Spanish tile look. It's built in 1984, 140 units, got some great floor plans in it, from 1, 2, and 1 and 2 bedrooms, many different sizes. Large-sized, 1.5 bathrooms in most of all 1-bedroom apartments. Sets himself really apart with that to the competition, which are the multiple other multifamily properties just across the street, and one right on the service road, and we are the second one coming off the service road. So for me, it was a great location, great looking property, pitched roof, individual AC units, and slab foundation, and had a nice self-standing single leasing center with it. And so I think it's a great opportunity. So we really like that property. Yeah.
How did you? I don't know how many bids were made on the property, but it probably was the first round and best and final. What did you learn from the 20 offers previous to now this one to really set yourself apart?
What I learned was after you make your best and final, you really sharpen your pencil, and you go with your team. You contact each part of your team and really have a detailed discussion about this and see what it is you can do in order to get your best offer to the seller. And the more often you do that, the more you learn every time in how to become better in this and to fine-tune your numbers to hopefully stand out and get this deal awarded from the seller.
So let's kind of walk through this property. Is it the last property you had was a stabilized property? Is this property a value added, or is it a stabilized property, or both?
So I think it's both. So we actually like to buy only stabilized properties. just because we like to have the opportunity to get immediate returns to our investors from the day of closing. Really, the property is performing and is earning money and producing returns. So that's what we like, and that's what we like to buy. We like the financing options we have with this type of properties because we get, again, the long-term Fannie Mae non-recourse loans on that. We like that as well. So these are two important factors for us, why we're choosing this kind of properties.
So what were the rents at acquisition now, and what do you think you can take them to?
So rent increases we have about $150 to $170 rent increases scheduled. We actually already have implemented probably 80% of those rent increase, even so we have changed very little on actually the interior upgrades. We are just owning properties now for 2 months, but we are already only $20 or $30 away from our scheduled maximum rent for year one after the upgrades. We haven't even started the upgrade process yet. So we're doing already very well on there.
What do you think the rents were so under market on this property?
Well, of course, every time I look at properties, I look at the competition in the neighborhood. And so I usually put boots on the ground myself. I actually walk the neighboring properties. I go in there. I see what they're doing. Are they upgraded or not? How do their upgrade look? How their offices look? How do they run their property? How the properties look? And what the kind of rents are they getting for that and charging for it? And you could clearly see that the two immediate properties across and in front of that, our property, was doing or has done already the same thing what we were planning on doing. And the rents they were getting were above what we actually have scheduled our rents going to be, our projected rents going to be. So we like to be on the conservative side, staying conservative on what we're projecting. This way we can ensure with a good amount of certainty success for our investors.
Was there anything else during the maybe due diligence and underwriting phase that you guys did in terms of reaching out to the city or having other team members on the property? Was there anything else you did during the 30 to 60 days there?
Yeah, so of course we're following pretty strictly what we learned from our mentor and of course what our team recommends. And our team is quite a large team that goes all the way from our mentor, of course, to our inspection team, to, of course, you two guys, from the lending side, who I always would like to have. And you guys came with me to the property. We're actually touring the property. When we're touring the property, touring that together. And each one has his own opinion and takes a look at it. And then we can discuss it later and make sure that this is a viable option for us to go forward and acquire that.
James, what do you think about that? What do you think about having the lender on the property in the front side of the deal?
I think it makes a huge difference, not only for when you go out and meet the broker, they see that you're serious, and they see that you brought your team out there, and they can add. A lot of brokers do know the financing, but then for you to be there and speaking on behalf of the buyer, that not only can they qualify for the financing, but this is how they're going to finance the deal and the rehab plans, and that the lender has seen the property, gives them a lot of comfort. And so it sets you apart immediately.
And we came actually late into that deal. So we only were about a couple of weeks before the first offering or the deadline for the offering. And that's when we actually just heard about this property and got into it. So I think we made a difference with the team we had. And like what you said, we came to the property, the broker met us, met the team. And I think we were taken serious immediately from that point forward. So it made a difference, I think. Allow us to get.
How did you find the deal?
Through, again, Brad Sumrock's group actually was on their box, where they list the properties which are available out there, was actually listed there. Mm-hmm. And talking to his coaches, they were telling me about it. They said, have you looked at this property yet? And I said, I haven't really looked at it yet because I was looking at other properties and making offers. So once they pointed me towards it, I actually was very interested in it and immediately started looking at it.
So when you negotiated the contract, tell us a little bit about that.
Yeah, so I think if you want to secure property right now in this market, I think it's of course important you make your offers with hard money. And it was in our case the same thing here. And once we got that awarded and we went under contract negotiation, there was really not too much to negotiate. It was fairly straightforward, other than make sure that, of course, that the title is going to be clear for us. And, of course, the lender side, everything is covered on the contract. With that seller, he was a professional seller, a professional multi-family apartment complex owner. So it was like, we had the professionalism on our side. He had it on his side. So it was a fairly smooth transaction. Still
A little bit different from the Shelby one,
very different from the Shelby
where
one.
it was almost like playing tennis, going back and forth and back and forth and back and forth.
Right.
So, but you guys went through a number of revisions too. But
We did.
And how long did that take you from the period of time that you had an accepted LOI to the time that the property really actually was under contract?
I think it took about 20 days.
Okay.
So not too bad. So of course we had on our team was our attorney, contract attorney. He walked through this and made me aware of things, and it was more or less really items which refer to the period while you are under contract to make sure everything goes smooth there in case there would be something happening to the property like a fire or so. And those little details had to be worked out, nothing big, just small details. And so everybody liked their own language, what is written in there. And once we got that worked out, it was no problem.
So I think another huge component while you're under contract is not only doing your due diligence, but then you're going to actually have to raise the equity for the transaction.
That's right.
And so on this transaction, you're able to take some of the money from Shelby, but some of the money from new investors. So maybe talk to us about how you presented the deal, what you did to get new investors into this deal, and then what type of returns were those investors expecting?
So raising the money is the smallest of the problems and the easiest, actually. So we had actually many investors already interested in investing with us in our next deal we would acquire. So I actually just took an email informing everybody that we actually got awarded a property. We have a property under contract. And so
So where do those people come from?
Because these people came from within
Well, networking events that we have attended and gotten to know, besides Brad's bus tours that we have, or going to his Rat Race to Retirements. We also attend the, educational things like Tony Robbins, or we've gone to Tom Hopkins through Brad's group as well, and things like that. And we just attend as much. We've gone to Quest IRA meetings where the people are there, and we just meet as many people as we can along the way.
So I think what's important there is that it's a process that they built, over the last 3-4 years, and built, sort of a database of investors.
Yes.
And at each one of these meetings, you're meeting 3, maybe 4 new people, but then over time it compounds.
Yeah.
And then so when you actually have a deal, the equity raise is not the problem. But sometimes investors will think, okay, I've been educated and I know sort of the numbers and how to calculate cap rate and how to underwrite NOI, but they haven't taken the time to raise or build their investor database.
The biggest thing that I've read recently, which I think is really true in this on the capital raise, is you're always working on your next capital raise. So like once we've found this property, all the people that we had met in order to meet the SEC guidelines, because we had an ongoing relationship with them, they could be potential investors in this. But now the ones we meet from this point forward will be in the next acquisition that we do. So you're always networking for your next acquisition. So you're always working ahead.
I don't know if you had said anything, but this didn't hurt either, that when you sold Shelby, you had what type of return back to the investors?
240% return in 3 years.
That doesn't suck. James, what do you think?
Yeah, so most people are getting 5-10% maybe in the market, maybe 20% this past year in the market, but not only earning cash flow, but then also returning a large amount of capital and then getting something on the back end when you sell certainly helps.
It certainly helps.
I will say that past performance is no indication of future returns.
Yes.
So on this transaction, when you presented, I don't know, did you guys do like a webinar or a conference call for your investors? What type of return were you forecasting for this, maybe on a 5-year?
So yes, we did actually a webinar, and this one was our first webinar. So our forecast was and is double-digit returns annually, and returning about 80% in 5 years. So I think that's a very good number. I think it was an average about 12-13% return annually, total return. So that webinar, it's easier for the individual investor because they don't have to drive all the way across town. And you can really put a lot of information across to quite a few people at one time. So it worked actually very well, and we had good feedback from that. I think it's important that you bring a lot of information to the investors about the property. And so what we did, you show pictures of the property, of course, but really talk about the numbers, about the returns, the annual returns, the rehab process, what kind of repairs you're going to do to the property, and just the business plan you have in the next 5 years with the property to bring that across to your investors, so they're well informed.
So how much equity did you need to raise, and then how many investors were in the deal?
We had to raise total, including our 1031 included, with about $2.8 million. And we have about a rehab budget, repair budget, about $700,000.
So altogether, we have now 21 investors, and 8 are from Shelby that rolled from one deal or one property to the next, including ourselves in there.
Yeah.
Okay.
Can we step back just for 1 second, talking about before the negotiation of the contract, that when you guys were in the offering phase and now having the seller interview you to find out if he wanted you to buy his property, because right now the seller has a lot of strength out there, so a lot of buyers have to have that conversation with the seller. Did you guys have a conversation with the seller, and did the seller ask you some serious questions about you?
So we didn't have a direct personal verbal conversation, but the seller actually forwarded a questionnaire, and a pretty detailed questionnaire he would like to have filled out, which we already were prepared for that.
What kind of questions were asked?
Basically about our history, our business history, our financial history, who we work together with, our multifamily experience, and also of our future outlook, business plan with the property. He was interested actually to hear what we're going to do with the property once we take over ownership. And I think to demonstrate also if we really have a plan, how serious business people we really are, and do we know what we're doing. So it was quite extensive questionnaire.
Do you see that, James, very often, having the seller ask questions?
I think especially on, larger properties, definitely over 100, 150 units. And then if they're listed with a broker like this one was, where you're having multiple offers, it's a way to narrow the field and really set apart the people. So really between that initial offer date, and typically there's about a week between the initial offers and invest in finals, they really send out a questionnaire that's 3 or 4 pages and ask, how you underwrote the deal and the rehab. And then having, has your lender seen the property? They just want to make sure that you know what you're doing, so that if you go in and apply for a loan, or you've done your due diligence on the front end, and so you don't come back and retrade on every little thing.
Yeah, they just don't want to misfire in the deal. So talking about doing the analysis of the deal, who underwrote the transaction? Did you guys underwrite the deal? Did you have your mentor underwrite the deal? I mean, how many eyes looked at this deal?
Yeah, quite a few eyes actually look at the deal. We put it together, and of course our mentor is the one who underwrites it. He looks at it, he makes sure it's good, and that the numbers all add up. And, of course, we work closely. Brad has his coaches now, and we work, of course, with Dante on that, who's also our broker and coach. And once we fine-tune everything, we usually let Brad look it over, and then he puts his check mark on everything, and then we're good to go usually.
So now that you guys have bought the property, first property was self-managed, and now you're moving over to third-party property management, as this property is a little bit larger and can handle it in terms of the expense. Before, you said you spent about 40 hours a week when you first bought that 41 unit. How much time do you spend now on this one?
Well, that was actually very funny, because when we closed on the property, and we closed November 8th, we actually didn't go to the property. The management company took over, and we said, well,
It was a very odd feeling.
We're going to visit next day. And so we scheduled 2 hours for it. And after an hour, I said, I guess we have nothing to do here. So we went back home. So very little time we spent there. Right now, we're spending about probably a couple of 3 hours a week right now. Yeah. Maybe be a little bit more, because we're starting our repair and rehab phase more aggressively now after the holidays. And
then meeting with the property management, just clarifying what our goals are, what we're looking for, what vision for the property, where we want to take the units, things like that. So it's more like a one-time time commitment. Yeah. Won't be ongoing like the property management is.
So 2 to 3 hours a week at the max right now. So not
so
very much.
Will you ever self-manage again?
No.
So you talked a little bit about the amount of money that's needed for the rehab of the property, and then So how did you calculate the funds needed for that rehab? Did you have a general contractor? Did you have some of your limited partners walk that property?
So here's what we do when we usually tour the property. Of course, our team is with us at that property, and the team really is between the lender from you, or then we have, of course, Brian Amos, who is doing the exterior rehab for us, and his people with him. We have, of course, Rayner, Multifamily, the management company, they're with us. And of course, my coach and broker is there with me as well. So these are all the people who are going to tour the property with us. And I'm going to point out what my vision is with that property. They're going to inspect the entire property, look at it. And of course, once we're under contract, we're going through the inspection period anyway. So they're going detail inspection then. And they're going to give me estimates what all this would cost to repair and to implement my vision, modifications, upgrades, whatever I want to do. And they put the cost together for me and give me basically the numbers, so I know what I have to raise on money in order to implement that later.
And then we had our key principal in it as well. He has a background in contracting construction, and he wanted to be there the day that we did the due diligence. So he did some research for the roofing, because it's tile roofing, how to seal it, to keep it maintained, keep it going. So he was a big part of it as well.
Do you like having the limited partners on the property take a look? I mean, you guys looked at 140 units. You can't do that all by yourself, or maybe you could, but I think that if they're going to put in $100,000 or $150,000 as a capital investment, they want to take a little bit of an ownership interest in the deal, making sure that they understand that they've walked a couple of units and see the condition of the asset itself, and definitely help you part of the due diligence and pointing out some things that may need to be taken care of. And you can always come back and say, that's important, but maybe that's not that important to be done.
Yeah, that's actually a very good point you bring up there, Paul, that I love to have my general partners with me at the property, because I want to have them see what I see.
Yeah.
And, you're not sharing responsibility, but sometimes they're more familiar with some part of the construction part of it than maybe I am, and they have a great viewpoint maybe on things which they can bring in as a team member. And like you said, when we tour 140 units, I can't be at the same place all the time. So to split them up, and they go as part of the team, they bring a lot of information in from their side, what they see, and to help making decisions later on. So yes, it's a good point.
So do you guys do this full time now? Are you pretty much all into real estate? Has your other business you stepped away from that, or do you?
The other business we've had for over 20 years, and we have a customer base in it. We don't want to desert those customers.
Okay.
So we're not actively looking for customers. We just are maintaining the ones that we have, which is very few. So maybe 1 week a month we spend on that business.
Okay, so maybe 75, 25 between
And
the two businesses.
the lender likes us having a paycheck from it, so we keep it going.
So maybe share with us some of the real estate goals you have for this year.
Our goal is really to purchase another property, about 140 units or larger. Of course, our priority right now is to implement our business plan with this 140 unit we just purchased. We'll probably, I would think, it'll be another 2 months before that really gets going and is implemented. And we make sure that that goes the way it's supposed to. And then we'll go and look again for another property.
Give folks kind of an idea of what type of loan and what type of terms you achieved on that property.
Yes. So again, we got Fannie Mae as a non-recourse loan with a 12-year term. Interest rate on it was 4.5% and 5 years interest only.
Wow.
And financing was actually 80% of LTC.
Yeah, loan the
Not
cost.
LTV, but LTC. So that was very
acquisition price plus the rehab into the deal. So they were able to achieve 80%. So how do you explain to somebody outside of real estate on what you do in real estate? I mean, how do you start the conversations with people? How do people start conversations with you? How do you start to try to build your network of limited partners and just have them kind of understand that? They kind of understand your hat you've worn for 20 years. And now some of the people that are new people to your group don't know what you do. So how do you explain to people?
So I think what I say often too to those people that our goals are really no difference. Okay, that what they're trying to achieve, we're already working on for 5 years, and it becomes financially independent. And that's really why we got into multifamily, to become financially independent from our current job. We had our own company, still wanted to get financially independent from that. So that was our reason we went into multifamily and got out of single family. And that is why we said we want to find a mentor how to do this right, so we do this successfully. So that's why we got into multifamily, and that's why we decided to educate ourselves and got us a mentorship and paid for this education to make sure we succeed in what we wanted to do. But that's our reason why we got into that.
Any advice for people who maybe have a 20, 30, 40 unit deal and now trying to buy 100 plus unit deal?
Yeah, I think it takes the same amount of work, I think, if you buy a 20 or 30 unit deal or 140 unit deal. As long as you have your mentorship, your team together, I think you can do it. I think you need to pinpoint in what you want to buy, what your criteria is in the property you want to buy, and then specifically look for that and pinpoint properties which interest you, if it's in your neighborhood or, whatever type of property it is which you want to buy, size-wise or age-wise. I think you got to stick to it and then really look for those properties. Form a relationship with your brokers, contact brokers, look at properties, and put offers in on those properties. And I think you will succeed in getting your own property.
Any... my big thing this year, I think, is around habits and, set a goal and then build a habit around that you do daily or weekly. Any habits that you would recommend for aspiring real estate investors out there?
I think your habit you should get is really do networking. Get out there, get to meet the people, do the networking, get to know your team, every member of your team. And so once you really do find a property, you have everything in place and the team is willing to work with you and go with you to the property so you can be successful acquiring it, because you're going to have to make an offer and you have to explain to the seller why you are the one who is viable to buying this property. So I think that should become your habit.
And you have to step out of your comfort zone. If you want to get somewhere in life, you have to step out of your comfort zone. The definition of insanity is if you keep doing the same thing over and over every day and you think you're going to get different results. We still talk about 5 years ago when that first R2R we went to, and when we walked out, it was so far of stepping out of our comfort zone, it was unbelievable. And we look back at it and laugh now, because if we would not have done what we did then and took massive action, we would not be where we are today. And we achieved our 5-year goal within 4.5 years. We have replaced all our income from our other business. So technically we could retire if we wanted, but now we enjoy this. We really enjoy what we're doing, so we're just doing it because we enjoy it.
And we are exposed to so many different people with so like-minded just through our mentorship itself. I mean, we were exposed to Tony Robbins. We went to Tony Robbins, and which made another big difference in our life. It really changed our life again and put us in a different direction and opened our eyes to other things. So the past 5 years were tremendous for us in changing our entire outlook for our rest of our life.
So on Casa Villa, how much hard money was there on that deal?
There was $150,000 hard money.
So were you nervous when you signed that contract?
Yeah, I was nervous. I was very nervous, yeah.
So we've always been banging the table for the last number of years about having women in real estate. I mean, you guys are partners. Rebecca, if I'm talking to Sven, I'm really talking to Rebecca. If I'm talking to Rebecca, I'm really talking to Sven. It's a little bit different, I think, in some partnerships, but you guys are the epitome of having the right type of partnership, because you guys work together, you live together. This is a passion that both of you guys have. Rebecca, now close Sven's ear. Could you do this all by yourself?
Yes, I could. And that's one thing that's great about this, is that I know that wasn't maybe the answer you were looking for.
No, that's the answer I'm looking for.
But in our other business, we were basically self-employed. And if Sven wasn't working, we weren't making money. And for us, that was always a very scary is maybe not the right word, but it was a very nervous feeling. So we were always financially secure because we always were looking ahead in case Sven didn't work. But once we got into this and got this ball rolling in our direction, we knew that if something were to happen to Sven, my life can continue on without him. So he has helped me to achieve so that I'm secure with or without him now. That's the difference. And I have the same support he has. And if I'm not there, he will have the same support that I'll have. So it just works from within Brad's organization. Yeah.
Yeah. I recently, I think I heard this as well. It's really what you guys have done in terms of education, whether it's Brad's group and other mentorships, but like Tony Robbins is really improved yourself And that's something that nobody can really take away. So even if they took away these 2 or 3 properties from you in a year or 2, you would build it back.
Yeah.
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 So no, that's great.
Yeah.
So we appreciate you guys coming in and spending some time and talking a little bit about the property that you guys sold and talking a little bit about the property that you guys bought. And if somebody wanted to know a little bit more about you guys, what's a good email address?
DSI 4 properties, and that's the number 4, not the word 4. So it's DSI 4 properties at gmail.com.
James, anything else going on in the Old Capital world these days?
I think we have a couple of events coming up here in March. So we'll send that out on our email list. So if you're not on our email list or you don't have our white paper on multifamily financing, go to oldcapitalpodcast.com. And on the right-hand side, you can subscribe there.
The new 2018 Old Capital white paper on multifamily financing, that's out. So we appreciate that. And then again, if there's any comments or anything, we love a 5-star rating on iTunes or Stitcher. Just give us some feedback, which if you thought we were pretty serious about what we do, and we're trying to help you, get you as much information and knowledge about multifamily investing. So we appreciate Sven and Rebecca being in the podcast. James, always a pleasure. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.